Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Chuck Fuller, Portfolio Manager at Nasdaq Dorsey Wright. He joins me to discuss asset class and sector rankings as U.S. equities retain the #1 spot, although it does present some risk considering how much we have moved just in the first couple of months of trading. Chuck, it's great to see you as always. Welcome back to Trade Talks. And really, the performance has been quite remarkable when you isolate it to the first 2.5 months of the year.
Yeah, it really has. I mean, we're already up, over 7.5% for the year already. If you annualize that, it gets to be a whole lot more. But we're not expecting to keep that going. I'm sure we'll have some pullbacks at some point, and and that's one of the things I wanted to talk about. For domestic equities, period, is that we've, like you said, we've had such a huge move up off the October bottom. We're around like 25% up. Which usually, that's obviously a good thing. But when the market does this in kind of a short period of time and without, having much in the way of drawdowns in the previous year, it can lead to some bad cases of market environments. So things like 1929, 1987. 1997 and 1998 were other market periods where we saw this kind of action. Now, some of those are extremely dramatic, right? 1929 is, when the market collapsed, before the Great Depression. You had 87, which was, when we had the 87 crash in the market. We don't really expect that to happen because, both of those markets before that, you were compounding at 30% a year, and obviously we haven't been doing that. And you didn't have any really significant drawdowns in, let's say, the last 5 years before those events. So I wouldn't expect that to happen, but it does present some risks. We could see the market pull back some over the shorter term, and it wouldn't be abnormal.
Right. Well, I mean, Chuck, if you think about it, rates of return typically average 8% on a year,
Right.
if my thinking is correct. So, I mean, for almost 8% now, if history is a guide, you could potentially see some of that volatility for it to average out at the end of the year. I mean, that's not an absolute, but when you think about it from that perspective, when you have your annual return in just 2.5 months, that,
Right.
not only do you have that risk in the market, but then also concentration risk. And again, we're seeing here that technology still remains the #1 sector. Are you seeing inflows or any rotation in other sectors besides technology?
It's mostly been stable. So like you said, technology at #1, and industrials and consumer cyclicals are, #2 and #3. And that's been that way for a little while. I would say probably the biggest move that we've seen over the last couple of months is healthcare showing some kind of life off the bottom. You figure in 2023, it had a flat return for the year when the market's up, roughly 25%. So a huge lag for last year, but we've seen some signs of life from it. Now, that being said, it's out of the 11 sectors that we track, it's moved up to #9, right? So it's still fairly low, but it's somewhat notable.
Yeah. What about fixed income? What's happening there?
Yeah, fixed income is rough. It's been rough the last 2 or 3 years, especially 2022. But it's still last in our asset class rankings. I was actually looking at it before I got on the call, and it's pretty remarkable. It's had roughly a negative 7.5% return over the last 3 years. Which is just unheard of. Usually with bonds, you're at least making a small amount of money every year. And to see the kind of returns that we've had it's really wild. And when we look at the charts for something like the 10-year yield, rates are still in a downtrend. With inflation, even though it's started to pop up a little bit, the rates are still moving down, but they have shown some strength over the last month or so. We've now got the 10-year up at around 4.3%, and really wouldn't hit an overbought level on our system until it gets to about 4.5%. So it has some more room to run, at least over the short term. I would say one good thing that we've seen is that bond volatility has been dropping strongly. Even with this move up, usually, with rates going up, you get bond volatility will also move up, but that hasn't been the case here. And so we're kind of hopeful that, this may just be a short-lived move up, and we'll resume the previous downtrend as we keep going.
And finally, Chuck, commodities are still #3 in your asset class rankings. Within the commodities space, what's #1?
Yeah, I mean, energy is at number one. And really, it's kind of interesting. It doesn't get a lot of talk this year so far, but with equities doing so well. But the commodity space is the best performing asset class for the year. And a lot of that is driven by energy. We've got crude oil is up 12.5% already for the year. It's not it's probably got another $10 to go before it reaches the peak that it had in 23. It remains to be seen whether we'll get there or not. But it's something to contend with. And it's not the only space within commodities that's been doing well. One of the crazy things that's happened this year so far is cocoa. So cocoa's up nearly double for the year so far, just so you know, in 3 months. And a lot of that has to do, apparently, there's some very bad harvests going on in Western Africa where they harvest a lot of the cocoa. But definitely not a good time for that, given that we've got Easter candy to buy in the next couple of weeks.
All right. Appreciate the insight as always, Chuck. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.